All right, let's jump right into this. Welcome back to our explainer on ASC 305, where today we are zeroing in on restricted cash, recognition, and measurement. Now, if you want to ensure the absolute accuracy of your balance sheet, you really have to look at cash as more than just a single static number. Think of yourself as an active investigator at every single reporting date. Restricted cash, in particular, demands two totally critical decisions from you every time you close the books: identification and current versus non-current classification. You absolutely cannot just set it and forget it. So we're going to break down exactly what you need to look for, when you need to actually record it, and how to measure it correctly.
Here is our roadmap for today's explainer. First, identifying restriction in classification. Next, the recognition timing rules. And finally, the face value rule and the specific steps for measuring petty cash.
Okay, Section 1. Identifying restricted cash, the reporting date interrogation.
So identifying a restriction is really about hunting down any legal, contractual, or regulatory roadblock that prevents your company from using its cash for general, everyday operations. Honestly, you have to ask yourself one very specific question. Is this balance restricted? You must ask this for every single bank account before it ever gets to hit the general cash and cash equivalents line on your balance sheet. Think of it like being guilty until proven innocent. You have to actively verify that the cash is actually free to use. To help answer that question, you should run every single account through a 5-question interrogation checklist. First up, check your loan agreements. Is there a requirement to maintain a minimum balance? Second, are there any escrow, pledge, collateral, or security arrangements tied to the account? Third, does a regulator legally mandate that you maintain this specific balance? Fourth, are there customer deposit obligations tied directly to it? And finally, is the account restricted to a highly dedicated specific purpose that limits its general use? Here is the absolute kicker. If your answer to literally any of these 5 questions is yes, well, that balance is officially restricted cash. You have to separate it out from your standard operating cash.
Moving right along to Section 2, current versus non-current classification, timing the release. Once you've actually identified restricted cash, you're faced with your second critical decision, which is classification, basically timing the release. You have to figure out if that restricted cash is current or non-current, and that depends entirely on the facts right now regarding exactly when the restriction is expected to be lifted. The 12-month rule totally dictates this. If the restriction lifts within 12 months of your balance sheet date, boom, it's current restricted cash. Beyond 12 months, it's non-current. Now, if the restriction lasts for as long as the long-term loan is outstanding, it stays non-current, but you have to reassess it every single year as that loan matures. Why? Well, think about this. If a balance was previously non-current, but time has passed, and now it's expected to be released in less than 12 months, you must reclassify it to current. It's a dynamic, living classification.
And guys, this brings us to a massive reporting risk. Failing to reclassify non-current restricted cash to current as that release date approaches creates an immediate glaring balance sheet error. It is just so incredibly common for a team to set up a 3-year restriction, mark it non-current, and then lazily roll that exact same balance forward year after year. By year 3, that restriction is lifting in just a few months, which means it should absolutely be classified as current. This is quite literally one of the most frequently missed period-end adjustments, and it's exactly why we have to conduct that reporting date interrogation every single period.
All right, Section 3, recognition timing rules. When does cash actually count?
So recognition is simply determining the exact moment a cash transaction officially enters your accounting records. It sounds super straightforward, right? But the specific trigger events actually vary quite a bit depending on what's happening with the funds. Let's break this down. When you receive cash from a customer, you record it the moment the company gains control of the funds, even if it hasn't actually been deposited in the bank yet. Now pay really close attention to vendor payments. You record this when the payment is initiated. The absolute second you write the check, send the wire, or authorize the direct debit, it hits the books. Do not wait around for the bank to process it. If you buy a cash equivalent, record it right at acquisition, assuming it passes the 3 classification tests. For restricted cash, record it when the funds transfer or when the agreement becomes legally effective. And finally, when a restriction is lifted, you reclassify it back to unrestricted cash the exact moment it is formally released.
Let's move to Section 4, the face value rule, measuring the dollars. Okay, so now we know what is restricted and exactly when to record it. But how do we actually value the dollars? Well, cash is a pretty unique asset because it is always measured at face value. A $20 bill is $20, period. However, while that face value rule is a constant, the actual methodology you use to get that measurement changes completely based on the type of cash you're holding. Let's contrast the two most common types here. For physical currency, you literally just count the coins in the bills. The physical count itself is the measurement. It's totally tangible. But for a bank account balance, you obviously can't just count the digital numbers on a screen. You have to use the adjusted book balance after all bank reconciliation adjustments are fully posted.
Let's make sure we define this perfectly because it is a vital accounting control. The adjusted book balance is the final measurement produced after all bank reconciliation adjustments are posted. It is absolutely not the raw bank statement you just download from your banking portal. The bank has no idea about the checks you've written that haven't cleared yet, right? And it is also not the unadjusted general ledger balance before reconciliation because that might be missing bank fees or newly earned interest. The formal reconciliation process is literally the only acceptable way to produce the correct measurement for your financial reporting.
Which brings us to our final part, Section 5, Measuring Petty Cash, the Fixed Fund Rules.
Petty cash is a really interesting special case. Unlike a general operating account, a petty cash account exists as a fixed authorized fund. That authorized balance is set on day one when the fund is established, and it just stays constant until management deliberately decides to change it. Because of this fixed nature, you have to use a totally unique additive measurement approach at period end. It's almost like a puzzle. Step 1. You count the physical cash remaining in the lockbox. Step 2. You add the value of all the unreplenished expense receipts sitting in that box. So physical cash plus the receipts. Step 3. Compare that new total to your fixed authorized fund balance. Step 4. If those numbers don't match up perfectly, you have to recognize any difference as cash over/short, which is an expense if you're short, or income if you're somehow over.
And that leads us to a really crucial final thought. A petty cash fund that consistently comes up short is a major fraud warning sign. If you measure your petty cash and you are finding shortfalls period after period, you cannot just lazily expense it to cash short and call it a day. It has to be investigated. All of these ASC 305 rules we've covered today, from aggressively interrogating restricted cash, to strictly timing when you record vendor payments, to enforcing that adjusted book balance, and rigorously measuring your petty cash, they aren't just annoying administrative bookkeeping tasks. They are the absolute frontline controls that ensure the integrity of your balance sheet. So as you apply these rules at your next reporting date, ask yourself, are you just blindly rolling last month's balances forward, or are you actively validating the reality of your company's cash? Thanks for joining me on this explainer, and I'll catch you in the next one.